In this question, there's a twist. The twist is that you only have accumulated depreciation on equipment. The fact that you don't have accumulated depreciation on vehicles, it means that vehicles are new, so you bought them in the current year. But here is what is fascinating. Even though the vehicle was bought in the current year, it wasn't really bought at the beginning of the year, but it was bought halfway through the financial year. So if our financial year starts on the 1st of March, it means halfway through the financial year, if I'm not mistaken, will be the 31st of August. So in the current year, vehicles were only used for 6 months. So yes, that is actually they do tell you that it was purchased on the 31st of August 20.7, which is just in the middle of the financial year. Okay. So we will start first by calculating depreciation on vehicles. Vehicles are pretty much new, therefore, however, in this case, your vehicles, they will have carrying value of 340, which is the same as the cost price. That is because vehicles were actually purchased 6 months into the financial year. We've only used them for 6 months. Now check how I calculated depreciation here. I multiplied, the numerator is the number of months over which you use the asset in the current financial year. And that will be over 12 because that 25% represents a year, which is 12 months. That's why I'm multiplying it by 6 over 12. So depreciation for the current year on vehicles will be 42,500. Always check that your depreciation doesn't exceed carrying value at the beginning of the year. In this case, there was no even cost at the beginning of the year. All these balances will be on the 31st of March because that's when we started using the vehicle. Okay. On equipment is a different story. And note that equipment is depreciated using the diminishing balance method. So we've had them for the entire year. So the cost price of equipment at the beginning of the year will be 200,000, right? And accumulated depreciation on equipment, I don't know why I have vehicles there, will be 38,000. And when you take the cost price at the beginning of the year, and then you minus accumulated depreciation at the beginning of the year, it'll give you a carrying value. Therefore, carrying value will be 162. And because we've used it for 12 months, note that when you calculate depreciation here, because we calculating depreciation using diminishing balance method, it has a lot of names. It's depreciation at carrying value, depreciation at book value, depreciation on diminishing balance method. It's pretty much the same thing. And in this case, we're going to multiply the depreciation rate by the carrying value because depreciation is calculated on diminishing balance method. And that'll give us 24,300. Just always ensure that your current year depreciation doesn't exceed carrying value at the beginning of the year. To record this, you're going to take the total depreciation for the current year, which is the sum of depreciation of your vehicles and your equipment, and that will simply give you 66,800, which is made up of 42,500, if I'm not mistaken, plus what we've just calculated now, which is accumulated depreciation on equipment, and that will be 24,300. So when you take 42,500 plus 24,300, it will give you 66,800. That's how we got the depreciation on the debit side. In the general ledger, though, please note that vehicles will be banked because we've just bought the vehicles in the current financial year. However, for equipment, we won't have bank. We'll instead have balance carried on because it was purchased about a year ago, 2 years ago. I'm not sure. And that's why we've got 200,000. On vehicles, please note that we will not have accumulated depreciation balance at the beginning of the year. Instead, we only have current year depreciation, and current year depreciation on vehicles will be 42,500, which is your balance carried on because we've got nothing on the debit side. And accumulated depreciation on equipment, because remember I said accumulated depreciation increases on the credit side, we will have balance carried down on equipment, which is 38,000, and you add it with current year depreciation on equipment of 24,300. In total, that will give you 62,300, and that will be your balance carried down. Depreciation, as I've said earlier on, is an expense. It goes up on the debit side, but the depreciation on vehicles only for the current year, and depreciation on equipment, which is 24,300. The accumulated depreciation will reduce on both vehicles and equipment will reduce your assets, and your depreciation for both equipment and vehicles will reduce your owner's equity. All right, that's it from me. That's all.